I was on the oil beat for the Journal when the Iraq War broke out in early 2000s. I'm having a lot of flashbacks to that this week with everything in Iran. In many ways, though, it's kind of worse, I think, because it's even more uncertain.
The US and Israel's position is you have to open the strait and you can't have nuclear weapons. Iran's position is we want a toll on the strait, which is going to create inflation. And, well, we must have nuclear weapons to protect ourselves.
The global crisis in 2008 was, first and foremost, a financial crisis. It emanated with housing speculation in the US and other markets and then spilled into, quote-unquote, the real economy. And what you're kind of seeing now is the reverse. It starts in the real economy, the stuff that you can touch, and then maybe it has a ripple effect into finance. It goes the other way.
Hello and welcome to another episode of Ways to Wealth. Today I'm joined by Peter. Peter, why don't you give us the TLDR on who you are and what you get up to on a day-to-day basis?
Sure. My name is Peter McKay, and I'm a marketer, content creator focused on emerging technologies, especially Web3 for the last 8 years or so. And I've also written 2 white papers for the World Economic Forum, or co-written, I should say, about possible blockchain applications in the global supply chain, which of course is a hot topic now. In a previous life, I was a business journalist for a long time. I was a markets reporter at the Wall Street Journal. Covered the great crash of 2008, as well as commodities for a long time, including oil, which is a hot topic right now. There are some legitimate risks out there right now. The oil shock going on, a lot of things in geopolitics, and that stuff is real. I mean, there is reason to be concerned about that stuff.
And we actually haven't seen the full consequences of what's going on with the strait, and we have information that's coming in. Ultimately, uncertainty creates opportunity, but it also creates a lot of angst and a lot of indecision.
No, I was on the oil beat for the Journal when the Iraq War broke out in early 2000s. Yeah. And I remember that, and I'm having a lot of flashbacks to that this week with everything in Iran. And in many ways, though, it's kind of worse, I think, because it's even more uncertain, I think.
Yeah, it's more uncertain, and you have basically this dynamic where the BATNA of both sides is in conflict still, right? Even though we have a ceasefire with the US, doesn't stop Israel from taking action. And then the US and Israel's position is, well, you have to open the strait and you can't have nuclear weapons. And Iran's position is, well, we want a toll on the strait, which is going to create inflation anyway. Well, we must have nuclear weapons to protect ourselves.
Yeah, and I think the complexity with the kind of, let's call them the non-combatant countries, the allies in Europe, I mean, they didn't like when the U.S. went to war in Iraq back when, but it's a whole different level now. I mean, now we're talking about potential breakup of NATO and things like that.
Breakup of NATO, a breakup of the breakup of the alliance. It's unlikely there'll be official statements made, but there's definitely been a deterioration in that partnership.
Yeah,
that we've seen, right? So, and that's why New Zealand's actually becoming a bit of a place of interest as this kind of Switzerland-like, on the edge of the world, out of the way of everything, kind of where your geographic hedge is.
Yes, yeah.
But a country that's also impacted by this shock.
Yeah.
But at the same time, we're running out of oil. We've improved the situation, but we're having a little bit of trouble with our fuel reserves, basically.
Yeah, I mean, that's the position most countries are in. If you're not an oil-producing country yourself, it's basically negative to your GDP.
New Zealand's good in the fact that we have 80% renewables.
Ah, there you go.
But the problem is the other 20%, we don't have a refinery now. So okay. That's where there's been a bit of a problem. And then I think we buy a lot of our petrol or oil from like South Korea, I think.
Yeah, okay.
The experience you had in 2008 and that era has some real similarities, like you said. And actually, on a relative basis, there may have been a similar, I guess, awareness of the public.
Right, yeah. Yeah, I think what's new, I mean, it sets off these very kind of sophisticated supply chain concerns that the average person doesn't register for them. And now you got to really stop and think about it. Like you were just saying, importing refined products from South Korea or wherever it may be. And the pandemic was like this too, I think, where people had to think about supply chain in a way that they previously didn't have to, and they could see it in inflation in a lot of places, in the flows of goods or just shortages on the shelves.
It's never reversed, right? You've not had a tipping point of price. You know, I think that's the interesting thing through this cycle is I think what you would have expected is that you would have got some level of price destruction in asset prices, in inflation, where like people just wouldn't pay.
Yeah. The way I think about it, in the global crisis in '08 was first and foremost a financial crisis. It emanated with, mortgage, housing speculation in the U.S. and other markets, and then spilled into, quote unquote, the real economy. What we saw in the pandemic and what you're kind of seeing now is the reverse. It starts in the real economy, the stuff that you can touch, and then maybe it has a ripple effect into finance.
Yeah,
it goes the other way.
That's right. Yeah, the GFC impacted people most that were exposed to property, whereas now it's consumers are most impacted, right?
Yeah.
And you see that in consumer prices of consumer brands, right? That were once priced at high PE ratios and then today not priced at anything because, the view is that the consumer has been completely destroyed.
Yeah. No, it's there's the metrics don't look good. I mean, here in the U.S., I'm not familiar with New Zealand's, to be honest with you, but in the U.S., the metrics on consumer purchasing power and the distribution and how much consumer spending is done just by the highest, say, 20% of earners or so. It's just outsized now, and you'd much prefer it to be broader based for the sake of the whole economy. And that's one of the most disturbing things that we have in the U.S. economy right now, in my opinion, is just how concentrated the consumer spending's gotten.
Right, that's interesting. And then actually how concentrated R&D spend has gone too, right?
Yeah, all around AI.
Same thing.
And huge. Yeah, and by the way, and there's also these surveys and other things where a lot of companies outside the tech space, they're excited about AI, but they're in this weird situation where they haven't yet found the application and the
application so far. The application so far is programming.
Yeah.
That's the real application. And if you look at the annual recurring revenue of Anthropic, guess who the biggest spender is?
Right.
It's Meta.
Right.
So, what are the big tech companies doing right now and how is Anthropic and OpenAI helping them? Well, it's most likely that they are actually getting very good at creating these what we would call agentic swarms.
Yes.
Okay? So what they're trying to push the boundaries on and what they're spending a lot of tokens on is basically orchestrated agents that actually produce output that is much more valuable than your average query that we're sending to ChatGPT. That's the social side, that's the zeitgeist side, that's what everyone's using it as a new search engine and doing their work with it, and it's becoming really entrenched in people's daily habits for sure.
Right.
But when you look at the token spend, there's a huge shift between the average consumer that's doing maximum, let's say, a $200 a month subscription and never running out of tokens, and Meta that might be spending $4 billion in a quarter,
right,
on tokens. I think it was like some silly number, like 40 or 60% of their annual recurring revenue was Meta.
Wow, that's amazing. Yeah, they're definitely, and you've seen with the layoffs they've done, they're keen to use it there to cut developer overhead.
They can as well. I mean, we've seen it in our organization. We've been able to put a lot of compute to work that really does replace labor. It does.
Wow.
And the great thing for us is that we're not encumbered with the old ecosystem. We're a small, grassroots-driven company at a very small scale. We don't have all the debt. We don't have liabilities on our balance sheet. We don't have technical debt, and we don't have human capital debt.
Right.
And a lot of these companies do. I look at myself versus your average consumer of a ChatGPT. There's a universe between the two. And then if I would probably say that between me and the individuals at these major companies, there's a universe between us, perhaps. I'm not sure.
Charlie, I think between, say, maybe you and like a Goldman Sachs or something, there might be. But like, I would wonder if we go outside the financial space. Like, I'm wondering about the impact across like just other industries that are non-tech industries, but really putting it to work, like, retailing or manufacturing or things like that. I don't know if we've seen the impact yet.
What you're cottoning onto is that there is actually a lot of application outside of programming that really hasn't been successfully implemented and used.
Right. And competing for talent, technical talent with the tech industry for a while. They hire a lot of engineers and things like that. They've been doing that.
And State Street and Millennium and, the market makers have become very advanced and they have a lot of talent built up in their organizations. And what do you think the actual impact there is in the finance space, in some of these market makers where you go, well, do you need that many employees to market make?
Before we were really talking a lot about AI, they had already moved a lot to what we call black box trading, algorithmic trading. And the job of traders, I think, had changed quite a bit. Like the floor, like it used to be, a lot of people, are familiar with they see the floor of the New York Stock Exchange on television and the people in the jackets waving their hands and all that. I mean, if you look at it now, it's been empty on the floor for a while now. The floor is more like an arcade now. And people are trading on screen. Yeah. So that transition's been going on. So I kind of see AI as like the next, step in that.
Just really disrupts classic capital models, right? Classic capital models are like, how do I adapt without disrupting the whole system? And that's kind of what Jamie Dimon said, right, from JP Morgan, is he kind of said that he would be in favor of basically governments almost enforcing them to not lay people off too quickly.
Right. And you have also in finance, I mean, as you know, like a lot of the other interesting transition that's going on is that a lot of the rails for the financial system are going on chain, which is interesting too.
Settlement's changing, and actually that's really disrupting banks' model. About 80% of code that's written is never used or utilized, right? Including deployed technology and features that are just never used, right? In Facebook, you only typically use certain number of features. Most features are very underutilized. And I don't think that percentage is increasing now that we have AI. And in fact, I would say that percentage, maybe even less, is actually utilized of output of AI. Like if you send me an email and I summarize it through AI and then send you a response and then you summarize that and then you give it to someone else and they summarizes it. Like how many tokens really were needed in order to do that? I think if we're all honest with ourselves, a lot of what we do isn't useful and we haven't been able to crack. We still hit barriers. I know for us, we've gone a long way. And realistically, I've probably saved, over the last year, I think we've probably saved about $500,000 of output. And for us, a company of our size, it's massive. $500,000 in extra output that we didn't have to pay for. We don't even spend $500,000 a year as a company. Now, have I been able to actually create intelligence that is autonomously taking away labor and not needing to be prompted or communicated? No, nowhere near. I'm trying my best, but there are barriers and there are...
Yeah, the technology's not at that level yet. It's not. It still needs the human in the loop, as the expression goes. The other interesting transition that's going on is that a lot of the rails for the financial system are going on chain, which is interesting too.
The bank's model actually is being disrupted, and there's a I guess there's a bit of a tension between basically the Federal Reserve and banking, and in that rails of stable coins and on chain.
Yeah, I mean, one of my favorite stories of the last, I think it's last year or so, is that hasn't gotten enough attention, is the Depository Trust Clearing Corporation, this entity on Wall Street most people have never heard of, which is the clearinghouse for all the stock market trades on Wall Street, as well as other products. They're experimenting with they have an on-chain pilot project. They want to clear securities transactions. Like, that's huge. DTCC is the back end of the New York Stock Exchange, NASDAQ, all that, and now they're talking about it. That's amazing.
What are you seeing in the Web3 space? I think it's been pretty turbulent. I think people are not excited by it at the moment. What are you seeing? What's going on?
Yeah, it's at a pivotal point. I mean, because you're coming off of you're basically in a bear market. Although maybe it's shown a little more life lately. But Bitcoin's trading around 70,000, down from over 120 last year at its high. And it's just, I think in terms of the mass market's perception, obviously AI has stolen a lot of its thunder. People just want to talk about AI. But for me, the other interesting thing that's happened is that the kind of the more what we would call the Web3 narrative, where the blockchain networks become a platform for applications, that really has, well, it's been hit and miss at best. I mean, it's never really gotten traction where you have all sorts of applications that people use every day running on the blockchain. That's what we had hoped for at an earlier stage. And but on the other hand, the financial use cases seem to be working pretty well. Bitcoin as a form of money, as a store of value, does seem to be having traction. And like we were talking about, some of these Wall Street use cases where the networks are having value as rails to build a new financial system upon. I think that has a lot of momentum. I think that maintains momentum. And, going forward, I think there's still a lot of value there. The value comes from the networks.
The real evolution here is basically financiers and the traditional banking class and is now, in my opinion, transitioning to the technocrats. And that's what the transition is. And blockchain is really a representation of technocrats eating the primary winners, which was the financial system. Yeah. And I mean, that's kind of my view.
Yeah, and you can see in the U.S., I mean, we can see that in the concentration of the stock market valuation just around what we call the Magnificent Seven tech companies. Yeah. I mean, as a former markets reporter, that blows my mind how, I forget the stat, like the top, you have about 7 tech companies that are all each worth over $1 trillion market cap. And out of the S&P 500, whatever the figure is, I forget if it's 25% of the whole value of the S&P has been in those 7 companies.
Yeah, and then about 32% if you take like kind of tech as a whole and you take the adjacent ones, you got like a 32% exposure there. And that's been typical of prior cycles as well, right? This isn't uncommon.
It's more extreme. Like at $1 trillion, or like I think the top company is like $4 trillion for Apple. Nvidia is the biggest now. I think Nvidia is 4 or 5 trillion, something like that. And it's bigger than certain. The S&P has 11 sectors built into it, and Nvidia alone or Apple alone is worth more than the smaller sectors in the entire sector.
Yeah, I think energy. I heard that energy represents only like 3%. Well, it's probably changed right now. It probably represents about 6%. Prior to that oil spike and the energy shock, you saw that energy was only 3% of the index. And that was like why you would be like, well, I'm actually cyclically bullish then energy, because there are these themes around the need to actually use energy in order to create tokens.
Well, the first immediate layer that we haven't talked about yet is social networks, which has been a hugely important channel for distributing content. And that's changed a lot by AI, because I think it will continue to be, because to me, I think AI is a real threat to social media, because the bots, I don't know that people want to be interacting with bots. If you're on any social media platform now, you can tell there's so much bot generated content. And I think it's fundamentally a problem, but I don't know if the platforms view it as a problem. If it can drive all their audience metrics, clicks, accounts, posts, so on, they might be okay with it. And on top of that, I'm wondering when the brands that buy ads on these platforms are going to get concerned with it. Because if you're a brand that's buying an ad on X or on Instagram or something, you don't want to pay the platform.
You want a real human, yeah. I mean, yeah. And I think that's what we've seen, at least from my experience of running a little bit of ads on the. Running ads on the Facebook network versus just organic relationship building like real, tangible, trusted relationships with cool operators that we can kind of come in contact with and have some time with. The intent is so different to what you get from your average Facebook ad that you're paying for.
Right.
And what I've noticed from ads is, like, it makes sense that it's going to work, and then you go, well, why is the intent so low? It's almost like it actually at the moment almost feels like those people aren't even real.
And increasingly, that may be the case in a world where there's more AI agents out there. Their traditional kind of reply to this problem is that they say that their advertising gives you more granular metrics as a brand than conventional media, than TV ads or newspaper ads or something like that. That you don't know, if you buy an ad on page 3 of the newspaper, you don't know how many people buy the newspaper that day, the print newspaper, but you don't know how many people look at page 3. And whereas in a granular way on a digital platform, and all that's true, but that was in 2000 that was a good defense. In 2026, I don't know that it works. Like that they get granular data, but the question is it bad data? That's a whole different question. A granular snapshot of all the bots. Who cares? Coming from a journalism background, I mean, to me, that there's this issue that they don't like to talk about, which is veracity. And most of their products that Silicon Valley builds tend to have problems with veracity. Search did, social did, AI does, and because what these systems, when they build them, they treat everything like zeros and ones. They don't like to deal with the issue of, well, which zeros and ones, or which, you know what I mean? And they're always reluctant to try to, get out of that, kind of neutral stance on which information is flowing over their network. But to make it usable by humans, that's exactly what you have to do. There's so much discussion around the rapidity of change in AI and forecasts, and people saying, oh, in 2 years, employment will be half of what it is. I mean, I think it is more of a gradual, it's more of a gradual transition. It's like that old expression that we tend to overestimate what new tech will do in the short term, but underestimate in the long term. I think AI is fitting that pattern perfectly.
Yeah, for sure. Pretty beautifully, yeah.
It definitely seems like there's a healthier conversation, in many ways a tough conversation going on around AI right now. And the hype cycle, in marketing, in tech marketing, they always talk about hype cycles that new technologies tend to go through. And I do wonder if we're going through what they call in the hype cycle theory, the trough of disillusionment, if it's not coming, where you're having these very practical conversations about, like your example with the emails, the bots just talking to each other, what are we really doing here? Yeah, and the power consumption and all these very practical issues. I think it's good that we're talking about that, because it can, you can,
yeah, for sure,
you can stop doing kind of like cool parlor tricks with it and find what is really driving value.
I think it's really exciting. Like, I think that the upside has to be as an individual contributor, which is, I think, where more and more people are wanting to be, is that where there is uncertainty, there is opportunity, and you have to be high agency in obviously looking out for how you can basically evolve, right?
Yes.
As best you can.
I agree, yeah. There's a lot of risks to the AI transition, but then there's also opportunities. And it's always two sides of a coin. They're kind of directly related.
I think that the upside has to be as an individual contributor, self-sovereign contributor, which is, I think, where more and more people are wanting to be, is that where there is uncertainty, there is opportunity, and you have to be high agency in obviously looking out for how you can basically evolve.
Yeah, that's true. There's a lot of risks to the AI, but it's always two sides of a coin. So this one is just very, very high on both metrics.
Well, thank you so much for coming on the pod. I've really appreciated it.
Well, Charlie, I enjoyed it. So, glad to talk again sometime.
Yeah, it'd be great.
If we can help. Okay.
Yeah, that'd be cool. Awesome, man.
Okay, man.
Thank you.
Okay.
Cheers.